Good morning, everyone. Welcome to this new International Energy Agency webinar for the Africa University. I propose we start now while more participants will be able to join us. So today, I'm very pleased to welcome Olivier, a colleague from the oil team, who will present to you the latest IEA oil report. And we will have time for a Q&A, so feel free to share all your questions on those findings. This oil market report looks at global market trends, but we'll deep dive in Africa and try to focus as much as possible on the continent. Before giving the floor to you, Olivier, just reminding to all of us why we are together today. So this IEA Africa University are organized by us, the International Energy Agency. We are an intergovernment institutions based in Paris, really at the heart of the energy dialogue between energy policymakers. In the world and in Africa, we basically do three things. First, we collect and provide data all across the energy sector. Two, we advise policies. And three, we support implementation. In the case of Africa, for example, with capacity reinforcement activities. The IEA is working on all the energy-related topics, even though we come with a very strong focus on oil supply and oil security. Olivier may be able to speak more on this background. So under a program we have, which is funded by the European Union, the IEA proposed capacity reinforcement activities on energy statistics and energy long-term planning to a set of sub-Saharan African countries. And we also have those more open webinars where any African energy professional is very welcome. You can already save the date for the next monthly webinar, which will be a presentation of the Global Energy Review report detailing how all the energy consumptions and all the energy evolved in the year 2020 and how they are to evolve in the coming year 2021. If you want to get more practical information and to keep posted on our activity, you can join our WhatsApp country groups and our LinkedIn community. Feel free to send a message on the chat so I can share with you all the links. Before Olivier enters in the presentation of the report itself, I just want to share a few slides on where is Africa today? Where does Africa stand in terms of oil? So if we look at producers and consumers in Africa, as you can see on this map, in Africa there are some major OPEC members which produce significant quantity of crude oil every year, and we also have non-OPEC members, including Ghana, including Egypt, for example. And when we look at the main African oil consumers in 2018, we can see that you can see the most advanced economies of the continent: North Africa, South Africa, but also Nigeria, Kenya. And these are absolute value of oil demand in the country. But if we look at the oil demand per capita, we will still find the most advanced economies. So South Africa is number 2 country. Then we have several countries in North Africa. But we also have countries with small population like Mauritius, which is the number 1, Botswana, Namibia, and Gabon. So this is the picture today in terms of countries producing oil in Africa and countries, top countries in terms of oil demand. So, but where does Africa stand in the global situation? The share of Africa in oil is relatively small. It's below 4% for oil demand, for production of refined products, and it's below 10% for the supply of oil and for the net trade. But if we try to have a look at how those indicators evolved over the last 2 decades, so here you can see on the left the evolution of demand between 2010 and 2000, and on the right between 2018 and 2010, you can see that the evolution of demand across those 2 decades have remained stable at a bit above 0.5 million barrels per day. But then when we look at production, there was an important increase in African oil production between the year 2010 and the year 2000 that we've not observed in the following decade. So the production has decreased over the last decade. And as a result, the exports, which were net positive at the beginning of the century, have become negative over the past decade. So these were some statistics on where does Africa stand today in the oil landscape. But as we do in this capacity reinforcement program, we try to drive and to anticipate some long-term trends. So if we do some long-term modeling, we can ask ourselves, what could the future look like and where Africa could be for oil in the coming decades. So here is, according to our stated policy scenario, how the oil and natural gas production could evolve by 2040. So looking at oil, you can see that we expect the same level of production to be maintained over the coming 20 years, with Nigeria, Libya, Angola remaining the main producers. But it's a totally different picture when we look at natural gas, where we expect a significant increase in the natural gas output in the continent, with newcomers like Mozambique and Tanzania, with the very important project that we from Cabo Delgado province, for instance. And if we now look at how oil production, demand, and imports are to evolve, so as we could see, oil production is set to remain stable, but oil demand will increase significantly. So this is a result of a modeling exercise where we look at each and every sector which are demanding oil. So it would be, of course, transport, but also industry, and also the building sector with, for example, backup diesel generator. And based on this bottom-up modeling approach, we anticipate an important increase in oil demand. As you can see with the red curve, refinery runs are to increase, but not as much as oil demand. So we expect also a rise in the net product import. And if we look now at a last topic, which is how countries are getting incomes from their oil and gas and hydrocarbons resources, you can see here, looking at 10 producers in Africa, how their income from hydrocarbon have evolved over the past 20 years. So as you can see, there has been a lot of volatility in those on these revenues due to the volatility of price, but also some volumes changes. And what's interesting is to look at how government expenditure have evolved. And as you can see, when there is an increase of the revenues for the government, the expenditure also rises. But when there is a drop in prices and a drop in revenues, it's tougher for governments to cut their expenditures as fastly. So there is really a strong need for those governments and those economies to diversify and to very carefully manage the revenues and the incomes from oil and gas production. And if we look ahead, so no one knows what the future will look like, but we can take hypotheses. In our stated policies scenario, we don't expect for the coming 20 years that the revenues for those countries will go back to the top levels we have observed since the beginning of the century. And if we took a more conservative scenario, in a scenario called faster energy transition with lower demand for oil and a high competition across the oil producers, we could see even smaller level of incomes for African producers. So just to emphasize again that for those economies who very very heavily rely on their oil and gas revenues, there is a very crucial and critical need for diversifying and carefully managing those revenues in the future. With those first points, I stop and hand over to you, Olivier, to enter more into details of the recent Oil 2021 report, which looks at how the situation evolved over the past year, and which looks at short-term forecast up to 2026. So thank you very much, Olivier, and the floor is yours.
Thanks, Arnaud. And hi, everybody. My name is Olivier, and I work for the IEA, as you've gathered, probably. And yeah, I've been at the IEA for nearly 5 years. And I've been part of the oil team that focuses every month on the oil market. So we do a report focusing on supply, on demand, on refining, the main aspects of oil trading and oil markets every month. And we also do an annual report, which we've published. This year was published in March, so just a month ago. And that's what I'm going to present to you today. So if you have any questions during my presentation, feel free to send them, and I'll try and read through the questions if I've got a bit of time, or at the end of the presentation. So what's happened to demand over the last year has been absolutely dramatic. Oil demand fell by nearly 9% in 2020, which is pretty much unheard of ever since oil became a commodity in the 19th century. It's really the biggest fall that we've registered in living memory, to be honest, and it's absolutely enormous, and it can be explained by the fact, by the pandemic, by the fact people were asked to stay home for large periods of time. They weren't allowed necessarily to go shopping, or they were strongly disincentivized by governments to do so. They weren't allowed to travel, to fly away on holiday, etc. So that had a huge impact on energy demand, and specifically here, oil demand as well. The impact is actually larger than on economic activity because global GDP only fell by something like 3.5% last year. So the impact on oil demand was 9%, so much larger. And as you see in this chart, we've kind of done a new forecast this year based on the latest information. And we don't expect oil demand to ever catch up with its previous trajectory. We think it will remain, it will have lost effectively 1 or 2 years of growth. That being said, we expect demand to grow quite strongly over the next few years. It won't reach the pre-pandemic level, but it will reach the pre-pandemic level by sort of 2022, 2023, basically. And it won't reach ever the pre-pandemic trajectory. That's what I wanted to say initially. So demand is expected to be something like 13 million barrels a day growth between 2020 and 2026, with much of the growth being sort of demand catching up with its previous state. So basically recovering from the crisis. So much of that growth will initially be in Europe and North America, which have been badly affected by the pandemic. But also we'll see some further growth in Asia and Africa, which will represent new demand growth with new requirements essentially from populations who wanting to travel or wanting to consume plastics, and that will basically create this additional growth of about 4 million barrels a day between 2019 and 2026. So if you look at the 2019 to 2026 growth, it's smaller than if you look at the 2020 to 2026 growth because of the pandemic. Africa is, of course, going to be one of the most dynamic parts of the oil demand sector. In relative terms, Africa is expected to be the second largest growth contributor over the next 6 years, as increasing amounts of people seek to travel and consume more stuff. And so we expect Africa to be quite dynamic. And in absolute terms, though, Africa is not going to be nearly as big a contributor as Asia. Asian demand is expected to grow very strongly over the next few years, as it has done in the last few years. So countries like India, China, Indonesia are all expected to grow quite strongly. And if we take all of these countries and African countries together, they're basically going to be responsible for 90% of the growth in demand over the next 6 years. So really a substantial chunk. And Europe, North America, the sort of traditional consumers of oil will basically not grow very much over the next few years. Petrochemicals is one of the most dynamic parts of the barrel, simply because there's currently no alternative technology to oil in that sector. And demand for plastics has actually remained quite strong during the pandemic. Even with new usage cases like masks, medical usage, etc., some parts of the plastics sector have actually increased, whilst the other parts like automobile manufacturing, etc., suffered a temporary fall in the spring in Europe and North America, but then recovered quite strongly through the rest of the year. So over the next 6 years, we basically think petrochemicals will be responsible for 70% of oil demand growth, a substantial portion of it. In the meantime, transport fuels like gasoline and diesel will essentially plateau. And in the case of gasoline, we think it might even peak over the next 6 years because there is growing competition from electric vehicles and other alternative fuels. And in the sort of developed world as well, those fuels have kind of reached they've reached all corners of society. There's not really that many new usage cases for gasoline or diesel. Jet fuel has been really the most affected oil product during the pandemic. Demand fell by something like 40% in 2020, which is really big. And we don't really expect the sector to recover fully until late 2023 or early 2024. It will take a few years for jet fuel to really recover to its pre-pandemic level. And the explanation is quite simple. We don't think governments are going to reopen borders very quickly this year. And we think people will be reluctant to travel as well, or won't necessarily have the financial means to do so. We think the recovery will be quite gradual. Another factor as well is, of course, the rise of online conferences like this one that we're having today, where basically we don't think business travel will be nearly as prevalent as before, even if business travel is only a small share of jet demand. So as you've gathered, we don't expect at the IEA, we don't expect our demand to peak over the next few years. We think demand will continue to grow by something like 4 million barrels a day between pre-pandemic levels and 2026 levels. However, it's not completely impossible to imagine a world where this happens, where demand peaks over the next 6 years, simply because there is growing focus by governments and private companies on climate change and on the energy transition. This growing focus could actually result into some downward moves for demand, and we've tried to map those in our report. And imagine a world where basically demand plateaus. So for this to happen, though, you would need several things to happen at the same time, such as increasing efficiencies in the transport sector, typically through fuel standards. You know that European and North American governments have been quite proactive in regulating fuel efficiencies for new vehicles, but they could be even more aggressive on this, and this could result in a further fall in demand. We actually think efficiency gains are one of the main reasons for the expected plateau in gasoline demand over the next few years. But on its own, these are not sufficient. You will need more stuff, more policies to influence demand. So you need probably behavioral changes from citizens, such as what we've noticed with teleworking over the last year or so. You would need more people to stay home and work from home, and this could result in a further fall in demand. Probably you would need governments to regulate that, or to kind of incentivize companies to adopt teleworking policies. Another thing that you could consider would be a doubling of the share of the number of electric vehicles. Not doubling, a 50% increase. So we expect currently in our base case something like 60 million electric vehicles on the roads by 2026. If you increase that to 90 million, a 50% increase, you could see a further fall in demand over the next 6 years. And finally, you would need to see other policies, such as the end of fuel subsidies in some countries. I know in Africa, there's a lot of subsidies for oil products, or the end of oil use in the power sector. Oil is still used in the Middle East, in some parts of the Mediterranean and Africa for creating electricity. So you would also need to get rid of that to see a plateau in demand. So if you take all of those policies combined together, then you could potentially see a world where demand peaks. But you need action now, and you need aggressive action from governments for this to happen. That's one of the key messages of the report for us. Now, sorry, Arno, you want to ask?
Yeah, maybe before you move to supply, there was one question on demand.
Oh, yeah, good point. Yeah.
Maybe if you can come to your slide with the trajectory. The question is it indicated that the oil demand has recovered from COVID-19 impacts? Is the recovery back to pre-COVID levels or higher?
So, no, we're not. We're still below the pre-COVID levels right now. We expect demand in 2021 to increase by something like 5 million barrels a day, when demand fell last year by something like 9 million barrels a day. So even on average, we don't expect demand to be above the pre-pandemic level in 2021. We expect it to be something like 5 million barrels a day, 4 to 5 million barrels a day below the pre-pandemic level. And the reason is, as we speak, borders are still mostly closed, and flights are still mostly suppressed, or at least flight traffic in the world is down about 60% from pre-pandemic levels still to this day. You still have some restrictions in Europe and North America and other countries as well that suppress oil demand. And the economy is also struggling to some extent. There is higher unemployment and lower economic activity. So that all of that means currently we're still below the pre-pandemic level. And we don't expect demand to recover above the pre-pandemic level before 2022, 2023, that sort of time frame. So that I hope that answers the question. So back on to supply, which is obviously the other side of the market. To meet fuel consumption, you need oil production. And so supply is a very important part of the market, and supply has had to respond to the fall in demand. And so we've seen investments fall by something like 1/3 in 2020, which is quite big, especially since investments in the oil sector had been plateauing for the last few years. So we're now at something like a 10-year low in oil and gas spending. And that's not really expected to recover in 2021. Some of that fall, I should say, is just a result of lower prices as well. So what typically happens is when demand falls, the oil price falls, and all the costs associated with oil production fall as well. Suddenly it becomes cheaper to manufacture and produce oil. There's less competition for workers, less price pressure on equipment, etc., etc. So we've seen in 2020, we've seen oil majors slash spending by something like 30%, and national oil companies, companies like NNPC in Nigeria or Saudi Aramco in Saudi Arabia, on average, we've seen spending from those companies fall by 20%. So quite big movements down, but not unheard of. Supply. We've seen periods of lower spending like that in history. It's just a natural response to the fall in demand. The question for a lot of people is whether this spending today, this lower spending today, will it create a supply crunch in a few years' time? And in the report that we published, we said we don't think that's going to happen. We think there's more than enough supply in reserve to meet the expected increase in demand. So you can see on the right-hand side, the yellow part, the upper yellow part of the bar. This represents oil that was stored during the crisis, and that can be used at short notice if needed. And you've also got a lot of countries from especially OPEC members have cut production during the pandemic and could quickly ramp up production if needed by just switching on fields. Countries such as Saudi Arabia, Kuwait, the UAE could quickly ramp up production if needed. You've also got the situation in Iran, which is under sanctions by the US government, but could also ramp up production reasonably quickly if needed. And then you've got the investments I mentioned, which are, yes, they are lower, but they are still happening. You've still got about 2/3 of the investments happening, and that's going to create supply growth over the next few years. Where do we see supply growing? The US, of course, which could respond quite quickly with its shale industry, but also the OPEC countries of Saudi Arabia, the UAE, Iraq, Kuwait, Russia also, which has entered an agreement with OPEC to reduce production, but Russia is quite keen and ready to increase production if needed. And then you've also got investments from a few years ago bearing fruit today, such as investments in the offshore sector in Brazil or in the tar sands of Canada. So all of these taken together, we think supply could increase by around 10 million barrels a day to 2026. It's not a major worry. It's available if needed over the next few years. African supply, quite a different picture. If we start with the OPEC African members, Angola, Nigeria, Gabon, we expect their production capacity to decline over the next few years because we've noticed lower investments in the sector. They will remain massive and really important producers, but their production capacity will ease down. On the contrary, you've got new producers such as Senegal, such as Uganda, such as Kenya, which are going to bring on new fields towards 2022, 2023, we think, for most of them. I think in the case of Uganda, there's a project, Lake Albert, I think it's called, that's going to be sort of given the green light in the next few months, or should be given the green light in the next few months. But maybe you have more information than I do on this. So I'd be interested to hear from you if you've got any information on this. And yeah, so these producers, though, they're not expected to really offset the fall in OPEC production from countries like Angola, Nigeria, and Algeria as well. Just checking if there's any questions at this point. Sorry, struggling with the Zoom. Do we have any questions, Arno? Can you see anything?
No, there is no. You can go.
Okay, so I'll move on to the last portion of this presentation, which is the downstream sector, refining, which sits in between supply and demand. Refining capacity is in crisis, or rather it's in oversupply, basically. Even before the coronavirus, there was more than enough refining capacity. We estimate something like 20 million barrels a day overcapacity, mostly situated in China, other Asian countries, and some in Africa, sorry, not in Africa, some in Europe and North America. You do need overcapacity, right? You need overcapacity in the refining sector because there's always maintenance taking place. There's always accidents taking place. But 20 million barrels a day overcapacity is way too much. And so even before the pandemic, we think the sector was undergoing a bit of a crisis. The pandemic has made it a lot more urgent, really, and a lot more significant as well. So if you count all of the expansions taking place as well, that's going to create even more overcapacity over the next few years. You've got expansions taking place in some Asian countries, some in Africa, some in the Middle East. You've also got closures expected that have been announced. Some in Europe, some in Asia, and North America as well. But then really not expected to reduce overcapacity by this much. In fact, we think net additions to refining capacity will be something like 5 million barrels a day, on top of the 20 million barrels a day I was talking earlier. So this is unsustainable, and this is in countries, in regions such as Europe and North America, and possibly Asia as well. In fact, we think we will see the third wave of global refinery closures ever since the Second World War, which could result in something like 6 million barrels a day of capacity closures. Africa is not really going to be affected by this phenomenon because Africa currently has less than needed refining capacity and is a net importer of petroleum products. So African refineries are not really expected to be affected by this, or maybe on the margin, you might see some closures, maybe some of the smaller refineries in Nigeria, but following the commissioning of Dangote over the next few years. But really otherwise, we don't really see much of this phenomenon happening in Africa. In fact, we think Africa is going to see its refining capacity increase. And as a result, we expect oil products imports in Africa to come down. In Asia, we will see the opposite phenomenon where net product imports will increase quite substantially with the strong increase in demand. So the Africa will be less dependent on the external countries for their supply of products, which is good news, I think, for Africa. And so really this last slide is the final slide and is the end of this presentation. And if you have any questions on the oil sector, on our forecasts and how we forecast demand, I'm happy to take those as well. Thanks for your time.
Thank you very much, Olivier. So I think we are getting one question now on supply.
So I see one question on the supply side. Can you comment on the proven reserves and how long they are projected to meet the new demand in view of the reduced investment in explorations? So we think there's not going to be a supply issue for the next 2 to 3 years, 3 to 4 years at least, simply because there is enough capacity in storage and from fields already operational that could be ramped up. Beyond this period, though, you will need, unless demand starts to peak, which is unlikely, but could happen, unless demand starts to peak, you will need to see new investments probably to meet this new supply. So companies are always looking to invest, and so there's not really a worry about reserves right now. There's more than enough reserves of oil to meet the demand, and it's really just about in 3 to 4 years' time, will there be enough investments in those reserves to bring on new fields? Once you have the reserve in place, you still need to invest money to create the infrastructure to produce and export the oil. So you will need to see those investments in 3 to 4 years' time, but even probably starting from today to some extent, to really see production coming to market. I hope this answers the question.
Yeah, I think it does. Thanks, Olivier. Maybe one analysis to share in the Africa Energy Outlook that we released in 2019. When we look at supply, we try to compare all regions and to see how Africa could, how Africa is positioned in the global supply market. And one key indicator we think producers have to look at more carefully is the time to market. So the time between a project or between the field is discovered and the first barrel of oil is produced. Olivier, correct me if this is too approximate, but basically we're trying to monitor this time to market and required time for producers to make these resources available. And in a world with increasing competition on on the supply side, we analyze that it's key for African countries to ensure that time to market is minimized and that the projects are developed as fast as possible.
Yep. Yeah, it really depends. The time to market depends on the type of field you're looking to exploit. So if it's shale in the US, it's typically a few weeks to a few months. But a complex offshore project could take several years, something like 4 to 5 years to bring to market. So it's really dependent on the type of technology and fields. Yeah. I see no other question. Shall we wait a bit and then...
Maybe while participants ask more, I have one for you, Olivier. In the course we have discussed a lot long-term projection. Your exercise is more about short-term 5 years outlook. Can you maybe elaborate a bit more on how you make your projections? What do you base your reasoning on to build those 5-6 years projections?
Yeah, of course. So we basically, the first task for us is to gather all of the data. And, the oil sector isn't the most transparent sector in the world. Like, it's quite difficult sometimes to get data, but we try and gather as much data as we can on demand, supply, refining, production, maintenance, anything that could affect the balances. So we gather data. We also look at other things like economic growth, plane traffic, car traffic, etc. We look at a lot of different things, but we basically bring together all of those figures into one model, and then what we do is we run a model that looks at the past relationship between oil demand and GDP, as well as oil prices. So we run what's called a linear regression model, with elasticities basically, and so different variables impact the oil demand in different ways in our model. And it's quite a simple model, actually. It's not very complicated, but that's the main strength of it, is you can explain quite easily what's going on with this type of model, basically. So that's how we do things. And we do something similar for the medium term, but for the medium term, we also take into account other things that impact the medium term and that don't necessarily impact the short term. Things like electric vehicles, car efficiencies, petrochemical plant investments. We don't necessarily consider those variables in the short term because they don't really help explain short-term moves in demand, but they do explain the medium term. So we also take those into account for the medium-term model. On supply, we do things slightly differently. We look at announcements from companies, and then we make our own judgment of what's likely to be brought online or not. And we also look at the US shale sector based on oil prices, and we try to model really the likely supply evolution based on oil prices. What we don't do on supply, though, is we don't model OPEC production. So we typically do not forecast OPEC production, but we forecast the rest.
Thanks, Olivier. We have 2 questions that came. Maybe the last one builds on your answer on the drivers for growth in the petrochemical sector.
Yeah, good question. The petrochemical sector yes, you're right. It's expected to grow. The reason is really just economic development. I think in Asia, Africa, Latin America, as countries develop, they tend to use more plastics, more cars, they tend to use more petrochemicals, basically. And so we expect this sort of catch-up phenomenon to occur over the next few years and to drive a lot of demand growth as a result. I don't really have a more sophisticated explanation than this. It's really just economic development and population growth as well.
And maybe on the way we try to model those trends in the long term, what we would look at is what is the level of demand for petrochemicals today in a given country, and to try to estimate how this is set to evolve over the coming 2 decades. We would look at other socioeconomic drivers, like how income per capita is to evolve, how consumption levels are to evolve, and based on historical data we have for other regions of the world, we will be able to assume how the correlation would be between this activity variable, so demand of petrochemicals, and a proxy variable like income, GDP per capita, and this would help us make some projections on the long term. Olivier, do you want to answer the last question on the storage and potential impact on prices?
Yeah, so there's a question here. Could the fact that there has been an opportunity for storage of oil products due to low demand during the pandemic, could this lead to drops in prices for end users, especially here in Africa, as most of the oil is imported? Yeah, absolutely. So I would say this has already led to some lower prices because oil prices fell in quite sharply from February 2020 onwards. And they have recovered since, but they remain, they've actually been quite strong these last few weeks. But overall for 2020, they were much lower than in 2019. So this led to lower end user prices in Africa, but also in other countries of the world. The storage itself, yes, it's the same phenomenon. Basically, if you've got too much oil in storage, this will continue to sort of dampen dampen oil prices. So yes, it has this effect. But yeah, oil storage is expected to come down over the next few months and over the next few years because demand is going to grow back up. But then it will remain a sort of dampening factor on oil prices for sure. Yeah, I would agree with you. One more question here. At the peak of the COVID pandemic, there were negative oil prices. Can you explain the meaning of negative prices? Very good question. So it's made a lot of news. This phenomenon of negative prices made a lot of news headlines at the time when it happened in April 2020. I said it at the time, and I continue to believe it, that it's not as significant as sometimes commentators and people would like you to believe. So what happened is in April 2020, I think it was April or May. I think it was April. Yeah, pretty sure it was April. But anyway, the NYMEX WTI futures contracts, which is the main futures contract in the US and the second most traded oil futures contract in the world, that contract briefly, in the few hours before the contract expired at the end of the month, it traded in negative territory for a couple of hours, which was really completely new and unheard of. And this was really the result of oversupply. The NYMEX contract is delivered at a place called Cushing in Oklahoma, which is a landlocked place in the US with lots of storage. But once the storage is full, the oil has basically nowhere to go except, be exported out of Cushing or be used by refineries, etc. But there was this phenomenon in April 2020 of a very brief overcapacity in Cushing, which really stressed the infrastructure of Cushing and meant that for a few hours, people were really desperate to not own oil because they didn't know what to do with it. There was no capacity left in the system. But right after the contract expired, the next month's contract traded positive, and then the oil price in Cushing has been positive ever since. It was just really these last few hours before the contract expired. This is typically a time of the day when fewer and fewer people trade the contracts, and there's less and less open interest in the contract, and so it's less and less representative of the market as well. So not a phenomenon not to be discounted, because it was quite significant in that it showed overcapacity, but also not to be overstated in that global oil prices were never negative. It was just a brief contract issue for a few hours in Cushing, Oklahoma in the US. It didn't necessarily represent the global oil sector at the time. And oil remains a positively priced commodity, of course, because it's valuable. So that would be my take on the negative price. There's another question here. What is your take on the impact of climate change and related policies on oil demand? So it's a very difficult question because climate change is such a huge phenomenon with really big ramifications for the energy sector and for the oil sector as well. So we think the climate change policies will have an impact on oil demand over the next few years, and they will have a downward impact on oil demand. We expect to see more investments in electric cars, more investments in sustainable fuel policies from countries, more focus from citizens on saving energy and using less fossil fuels. All of this will lead to lower oil demand, no doubt. We just don't think this will have a big impact for the next few years, because this will be offset by increasing demand from energy hungry places and from new consumers in Asia and Africa. So this will have an impact, but it won't be that visible for the next few years. However, over the next few decades, this is bound to have a much bigger impact. And for this reason, we need countries to take aggressive policies to reduce climate change and reduce oil demand as well. So we think demand will plateau in Europe and North America, largely because of climate change policy over the next few decades and years. And this phenomenon may then also happen in Asia and other places of the world. So I think if you look at the World Energy Outlook, which makes scenario predictions all the way to 2040, they expect oil demand to peak in around that time, 2035, 2040. That's obviously highly uncertain and bound to evolve. because we just don't know at this point what countries are going to do. There's just not enough focus from developed nations, especially on this issue of climate change, and policies aren't aggressive enough. So they could do nothing, or they could take much more aggressive policies. Regardless, there's going to be an impact. It's just the severity of the impact will depend on governments. We kind of rely on them to take the policies here to impact oil demands.
Thank you very much, Olivier. Maybe to link on that question, we will have in 2 months from now a presentation of a forthcoming report from the IEA, which are trajectories to reach net zero by 2050. As you know, climate change is very much related to greenhouse gases emissions, and we are working on a modeling exercise to see how the world can be under a trajectory where emissions are reduced. And this, of course, is very much looking into the use and consumption of hydrocarbons, so oil, gas, and coal. So we will soon be able to share much more details on the levers policymakers have to make these emission reductions happen. And we will present this report in 2 months from now under the same format of IEA Africa University. I think there is no more questions, so I'd like to thank you very much, Olivier, for your time and for the excellent explanation you gave of the report and your explanation to the questions. Thanks to all of you for your participation, for your question, for taking the time to listening to us. We'll see. We'll have in 1 month a new presentation on the global energy review, which is a report where we look at all the fuels, all the energy items, and how their consumption have evolved over the past year, and also making forecasts for or estimation of their evolution in the year 2021. So this will be about oil, but also gas, coal, electricity, heat, renewables. So I'm sure it will be of interest to all your countries and situation specific situation you have in your countries. So looking forward to seeing you again under these webinars, and feel free to reach out for any question that we may not have addressed today.
Thank you, everyone. Have a nice day.
Bye-bye.
Take care.